Hey, what's up guys? My name's Daniel with Invest in You Finance, and today we are going to be talking about pulling out money from your 401k. Ooh, everyone's afraid of pulling out money from the 401k because they're gonna lose money. Yes and no. And this video is just gonna talk about a strategy to put 20% down on a home because we're gonna want to avoid paying PMI. I just wanna show you guys that there are options out there if you do not have 20% down to put on your home. And in this video, you can see the numbers and then you can decide whether if it's worth it or not. All right, so for the example, we're gonna say that we're buying a $200,000 home. So 20% on a $200,000 home is going to be $40,000. Well, let's say we only have $20,000 to put down on this home and we need another $20,000. Guess what, guys? You have the option of pulling out money from your 401k in the form of a loan, and this will not count as income whenever you pay taxes because it's a loan. And you're borrowing money from yourself because you've saved money in your 401k throughout the years. Now, if you want to do this strategy, the whole purpose of doing the strategy is to avoid paying private mortgage insurance. The bank is going to want you to put 20% down into the house because they need to make sure that that loan is going to be secured. And if you don't put 20% down, you have to pay private mortgage insurance. So if you put 10% down, you have to pay private mortgage insurance. And that amount of money is going to be, I think I calculated it to be around $100 per month. That is not going towards the principal of your house. It's going towards nothing. It's going towards the bank, and they're keeping all that money because you did not put 20% down. If you have 10% and you put $20,000 down on your home, that means you are going to be having an estimated payment of around $900, plus you're going to be paying PMI of $100. And this is going to be a payment of around $1,000. Every month, you're paying $100 towards PMI. Well, it's going to take you about 7 years to build up the 20% equity so that the bank removes the private mortgage insurance that you've been paying on. And if you multiply $1,000 times 12, because that's 12 months in a year, then you're gonna multiply that times 7 years because that's how long it's gonna take you to build 20% equity in your home. And that amount's gonna be $8,400 that you've just given to the bank because you only paid 10% down and you didn't pay 20% down. So you were forced to pay the private mortgage insurance. Now let's talk about pulling out $20,000 from your 401k to put that towards your home purchase. You already have the $20,000 and you're gonna pull out the $20,000 from your 401k. Combined, you will have the $40,000 of the down payment to equal 20% on a $200,000 home. Well, now what's gonna happen is you are no longer going to be paying the private mortgage insurance. So you can subtract the $100 out of your payment, you're not gonna be paying that anymore. And now because you put 20% down, your payment's gonna go from around $900 to around $800 every month. So now you're only gonna be paying $800 every month because you avoided PMI and you avoided paying $8,400 in 7 years. But now we pulled out that money from our 401k. So there's a trade-off, and you won't have that money in your 401k, but you won't be paying private mortgage insurance. This is just a strategy that's out there that people should know about in case they want to go that route of pulling out money from their 401k. The 401k loan to yourself is typically between 1 to 5 years, and if you do 5 years at around a 6% interest rate, the payment to your 401k is going to be around $400 every month out of your paycheck. So this is just another way to pull out money from your 401k to put 20% down on your home. And once you pay off that 401k loan to yourself, you're not paying interest towards anyone. You're paying interest towards towards you because you borrow the money from your 401k. So at the end, you would have made, if the loan was around 6%, you're going to be making, around $2,000 to $3,000 from the money you borrowed. And yes, that might not be more than how much you would have made if you left it in your 401k and it was making money in the stock market, but you never know. The stock market could have had, a few years where it only returned maybe 5%, or maybe it broke even, didn't return anything. Well, during that time, you would have paid yourself back 6% every year. Also, you might want to consider that, yes, the stock market could have gone up those years, and maybe it was 10%. So that year you lost out on 10% because you were only paying 6% to yourself. So you lost out on about 4% of that money growing. But you gained money by not paying PMI. So everything has a trade-off. The thing is, you're moving money from your 401k, which is an asset, to another asset, which is your home purchase. So the money's going sideways. You're not pulling out money to, blow it on something that's not an asset. You're pulling out money to put it into your home. This is one of the only reasons that I've pulled out money from my 401k, and that's to pay for a home. We're gonna get into the numbers, and I'm gonna show you the example with some calculators online. So let's get into it. Here's the video. Okay guys, the first thing that we are going to want to do is pull up a PMI calculator to figure out how much we are going to be paying on our PMI. So we're going to type in how much the home cost, and then we're going to type in the loan amount. So because we will be putting 10% down, the loan amount will be the 200,000 minus the 20,000, which is a 10%, and that's going to come up to be 180,000. Then we're going to choose our credit score. I just wanted to see what the average credit score and what a fair credit score would be. So an average will be around $85 monthly for PMI. And then I did a fair credit score, which will be around 106. So for the example, I just chose to do $100 per month for PMI, just for easy math purposes. And of course, if you have better credit, you will be paying less on your monthly PMI payment. The next thing that we are going to want to do is open up a mortgage calculator that includes PMI. Just for this example, I'm not including taxes or home insurance because I'm trying to just compare the difference between paying PMI and not paying PMI. So the down payment that we're going to do is 10%. The mortgage amount will be 180,000. For this example, we're going to use an interest rate of 4.25. And because we're paying $100 for PMI, that's going to come out to $1,200 per year until we reach 20% equity of the home loan. And we're going to start the date off January 1st, just so it can calculate easier and you can see how long it's going to take to pay off the PMI. Like I said, I'm not going to put any property taxes, home insurance, or HOA fees. It's just going to be the monthly payment and PMI. After we calculate it, we have a monthly payment of $885, and the amount of money that we pay for PMI is $100 per month. So our payment is $985, close to $1,000. As you can see here, the interest that you will be paying on this loan is going to be $138,000, and the total amount for PMI is going to be $7,200. $200 for the duration of the loan. So this example shows that you're going to reach 20% equity in 2026. So that's 6 years. And it's going to cost you around $7,200 that you will be paying in PMI for those 6 years. And this is why we want to avoid PMI. But another thing that will save you money is the interest. Because if you put 20% down, you will be paying less interest. So you scroll up back to the top. And we're going to pretend now that we put 20% down. So now our loan will be in the amount of $160,000. So now after we avoid paying PMI, the payment is $787, close to $800. And we saved money by paying less PMI, by paying no PMI, and by paying less interest. The total payments are now lower than when you pay PMI. Because you are no longer paying all that interest, since your loan is not $180,000, it's $160,000. The next thing we're going to want to do is calculate how much the 401k loan is going to cost. So if we pull out $20,000 from our 401k, and the 401k is going to charge us around a 6% interest rate on average, and we want to pay it back in 5 years, it's going to cost $3,199 of interest. But this interest is going to be paid back to yourself, to your 401k. So because you borrowed $20,000, you're going to put back in $23,199 back into your 401k over the period of 5 years. The next thing we're going to want to do is calculate how much they will be pulling out of your paycheck. If you get paid bi-weekly, like most people do, you're going to be paying around $178 per paycheck back to yourself. So here's just a recap of the calculations. If you put 10% down, the total of all your payments to this home is going to be $345,000. And if you put down 20%, the total of all payments is going to be $323,000. If you subtract those two numbers, you're going to save $22,619 if you put down 20% to avoid paying the PMI. And that's going to cost you $178 bi-weekly. But remember, this is a lateral move. You're paying yourself back. So the money is just going back into your 401k. Okay, now that we've seen the video on the calculations, now you can ask yourself, is this something I want to do? Is this not something I want to do? And then ultimately just get online, play with some calculators, write it out on a piece of paper, and do some calculations. There are options out there if you do not have 20% down for your home purchase. And this is just one option. Now that you know that you can do it, it's up to you to decide whether you want to do it or not. So this is just something that's out there, and I just want to make sure that you guys are aware of it. Like I said, I did it, and I did it knowing that I was probably gonna get some promotions with my job, and I was probably gonna get a bonus or two within a few years. My whole intention was to ultimately just get the 20% for the purchase of my home, then worry about paying that money back to my 401k within those 5 years. You can pay that money back quicker if you have the funds to pay it back. I ended up paying it back in a couple of years instead of the whole 5 years. And it just so happens, just by luck, when I pulled the money out of my 401k, I pulled it out at the peak, meaning the stock market was up around, I think it was maybe 20% when I pulled it out. Well, luckily, and this is all just by luck, the market went down, and I think it stabilized maybe like up to 5% instead of from 20%, it dropped like 15%, and it was only about 5% positive at the time. That means that when I was repaying myself back into the 401k, I was buying the stock inside my 401k at a discount because the stock market as a total had gone down 20 to 15% down to like positive 5%. So I was buying the stock at a discount. That's just something that luckily happened. It could be that you borrow the money from your 401k, and guess what? The stock market keeps going up. So when you're paying yourself back, you're buying it at a higher amount. So yes, you will lose out on some of that money. So just know that there are risks when you pull out money from your 401k, but there are rewards by putting it into your home. This concludes the video, guys. I just want you guys to hopefully like and subscribe. I really appreciate you guys watching the video. This is just a strategy that's out there. Please consult with your CPAs, your financial advisors. This is just an entertainment purposes video only. I just want to show you guys what I've done and what strategies are out there for purchasing a home and putting 20% down to avoid PMI, which is money that you're just giving away to the bank because you did not meet the 20% down payment. Okay guys, I'll see you next time. Thanks a lot. Take care. Bye-bye.